Okay, so we're recording. We're going to switch things up a little bit tonight. I'm going to go through the PowerPoint, go over the major concepts, and then we're going to assign each of you some problems, and then we'll take like a half-hour break to work through those problems. And then when we come back, I want you to walk us through your solution for the problems in the class. And we're not going to look at the 10K tonight, the real world 10K. We'll just use the information provided in the book for the problems. In large part because I want to be able to make sure that we're staying on track for the test questions. We have our first test in 2 weeks, and I want to make sure that we're learning the right stuff, not getting too sidetracked by trying to apply to a real world 10K. I won't be on the test. There we go. That's the last student. Okay. All right. So last week, just as a recap, we talked about profitability analysis. Oh, great. Okay. We talked about profitability analysis. And it really came down to two different ways of doing it. One, we could do a DuPont analysis where we really tear apart return on equity and return on assets into their components and dig down to look at how the companies are doing on those ratios. And if the components of those ratios are consistent with the outcome. And then we also looked at, instead of doing a DuPont analysis, we also looked at tearing it apart and looking at just operating costs, or excuse me, operating expenses and operating liabilities and operating assets, with the idea being that the non-operating assets and liabilities are a poor indicator of actual success of the company. So if the company holds a bunch of stock or a bunch of non-operating assets, that's kind of meaningless if they're to judge if they are good at what they do. So that was the second analysis point. So we're going to build a little bit on tonight on the operating, the operating analysis. So for tonight, we're going to get into credit risk and just risk in general. So I was looking at chapter 3 as I did my review and then lost my place where I wanted to start with chapter 4. So let me just get back there. Okay. So let's talk a little bit about credit risk. Interesting topic, right? So if you're an investor, if you're going to buy stock or you're going to work out a deal with a company, you want to know if they're going to be around in a year or 2 years. If you want to know if they're going to go bankrupt, and this is, or if they're going to be able to pay back the money you loan them. So this is kind of very important. Probably the most important part of any kind of analysis. So let's talk a little bit about what the market for credit is. So companies use credit for several different things, for operating costs, for investing and financing activities, right? And there's lots of different parties out there that offer credit. So trade creditors. So this is trade creditors is a term for, like, if you're buying from a supplier and they allow you to buy today, say buy the inventory today, but pay, in 30 days or 60 days. That's typically a trade creditor. So they're selling you parts and supplies or whatnot, and expecting a delay before they get paid. And there's banks. I think we're probably all familiar, just as consumers, with how banks work. Well, banks loan to big businesses too. And there's private debt investors and there's private lenders. And how this all works is just the laws of supply and demand affect what money's out there. The more, people want to get into the supply of debt, loaning out money based on how much interest they can get back, and what their next best opportunity is. So it really is just really basic supply and demand. Okay, so there are high risk and low risk types of financing, of credit. So most businesses will have a cyclical a cash need, and they might need to borrow based on that. I mean, businesses from tiny businesses to huge businesses have ups and downs throughout the year. So they might have to have a credit line to be able to make sure they make payroll during the lean months. And then they don't need it in the non-lean months. That's pretty low risk. Seasonal type thing. So, like Home Depot, which is used in the book a lot here, they're gonna have to bulk up on like snowblowers in winter, so they buy that on credit. It's kind of a seasonal thing. There are credit demands that are much higher risk. So if the company is borrowing money because they're experiencing massive operating loss and they're trying to make payroll, and that's a high risk thing. So that's the kind of thing where the lender is going to want to suss out why the company's borrowing. And finding that willing creditor could be the difference between bankruptcy and continued operations for a company. So some of these credit needs are life and death. Like one thing, if you watch like Shark Tank or some of those shows, one thing they'll ask with like, why are you here for the money? Like, well, some of them are, I'm here for the money because I don't have any. And some of them are like, well, I have a purchase order for 500,000 units, and I literally don't have the money to make them. So those are much different credit risks. Okay, so you also borrow money for investing activities. And this is one of the biggest reasons why companies borrow money, is to purchase property and equipment, plant, machinery. Typically, you would look at a long-term debt for that, a mortgage, something like that. You're appreciating it on your financial statements. Mature firms also settle into this predictable capital expenditure pattern, where they can predict year after year how their capital is going to be expended. So sometimes they'll need to make update capital expenditures in a regular cycle every 3 years or whatever. So they'll be taking out long-term debt for that. Startups, especially like high growth startups, will take on long-term debt in order to finance their activities while they're building up for that exponential growth. Okay, so less frequently you have financing activities. You can borrow money for operating and investing. So much less free. I mean, as you can imagine, who borrows money to put it in the stock market or to borrow money to then to invest in a startup that's in your industry or whatever. That's rare. It does happen. Leverage buyouts are kind of this investing type of thing. So we see this in my industry where we'll borrow, where we want to invest in a company that has some interesting technology that we want to be a part of. So sometimes we'll borrow in order to invest in them, which works out for us because we have the credit stability to borrow, and then we can cheaply buy into a company, but it's pretty rare. All right, and so then like common situations here, a bank loan or bond comes due and companies don't have the necessary funds on hand, right? So that's one of the reasons why it's pretty infrequent. Okay, so let's talk a little bit about trade credit. So most of the time trade credit is non-interest bearing, like you're probably familiar with like net 30 or whatever. So typically this kind of trade credit is non-interest bearing, but if you pay quicker and easier, then you get a discount on your invoice. The suppliers will, however, impose terms so that to protect themselves. So pay early, like I just said, like net 30. or a maximum credit limit. You can only buy 5,000 from us on credit before we'll stop, cut you off so you pay us. Maybe in payment terms, in addition to like net 30, maybe it's like you have 2 months to pay us off. And other restrictions. There's all sorts of different things out there depending on the industry and the amount of the cost of whatever they're buying. And they often will tailor contractual terms to customers' existing and ongoing credit worthiness. And that's another big one. If you're a company, you're buying, well, this is what happened to Fry's. I don't know if you guys ever went to Fry's, but they suddenly started having a lot less stock to sell because they were being so far behind their payments. So suppliers are like, yeah, we used to give you favorable terms. We're going to stop making those favorable terms. And then they cut it down even further because, they weren't getting their payment in time. So then it was like, we're only going to let you send you stuff if you pay beforehand. And then Fry's stopped having an inventory, empty shelves. And then they went out of business. Okay, bank loans. Like I said, we're all pretty familiar with bank loans. It's the same thing for a business. It can be harder for us, like a small business, to borrow from a bank. So like when you and I go for a bank loan, they're gonna look at our income, they're gonna look at our credit score, and that's pretty much it these days. But there's no credit score for most small businesses. Larger businesses, more established businesses will have a formal credit score, but it's a more of on case-by-case basis. The bank evaluating the business. So the loans will be structured quite heavily based on the circumstances of why they're borrowing and the borrower. And there's some standard types of loans. A revolving credit line. A lot of us are familiar with this, kind of like a credit card. Floating interest rate, typically pegged to LIBOR or something, some common interest rate. Letters of credit. This is a big one. So like just this year we had a situation. So we had a situation at work where we started using a payroll supplier to do some payroll out of state for employees that were telecommuting. And so if you have like a payroll like an ADP, they're paying the employee on your behalf and billing you. So if payroll is $100,000, they're kind of worried they don't want to pay payroll and then not get their $100,000 back. So one of the options was we have our own bank give them a letter of credit saying we will back it up. So that we will pay up to $100,000 if Kaiser or my company doesn't pay. So that's a letter of credit. So the bank provides a guarantee of payment. So they're not actually providing any money, but they're providing that guarantee that if there is needed, they will pony up the money. So typical loan terms they can be very dependent on the situation with business loans. The set loan amount but periodic payment, periodic interest rates. Mortgages. So commercial mortgages are different than like home mortgages, but it's the same kind of thing. You put up collateral of the building. It's typically a 7 to 10 year payment term with a balloon payment at the end. Idea being you're going to refinance all that at the end of that term. You have mortgages for other things. Typically, it's real estate, but there are other collateralized big ticket purchases in the business world. Okay, supply of credit, other forms of financing. All right, so there's non-bank private financing. All sorts of different wacky things here. So everything from like the mob kind of non-bank private financing, but also like insurance companies. They have all that money that they're sitting there waiting for claims, and they'll invest in the companies. They'll lend out. Pensions will lend out. Private equity will often lend out money. So that's all examples of non-bank private financing. And then leasing. Well, businesses love leasing. Leasing companies love leasing, right? So it's a win-win all around because the leasing company holds title to whatever they're leasing, and if you default in the payment, they just come pick it up. There's not any really extra court process to foreclose like there is like on a mortgage. So it works out well. On the other hand, it can be hard to, even though on paper it works out well, to recover that leased that's in default, the leased property. It can be hard to do that. So like leasing companies that maybe it's like leasing a lot of farm equipment to a farm, or they'll often require that they have a key to the storage facilities where that equipment's kept. Like they have a way to access that to recover it if you default. Okay, so publicly traded debt, right? So there are credits on the market. It's governed by the SEC, even if you're not a public company, and some are excluded. So like some forms of commercial paper are short-term debt excluded from SEC oversight. Some transactions for private companies are governed by the SEC, some are not. So there's just this extra level of regulation on some of this stuff, even for private companies. And then also you can sell bonds, very common for especially government entities, but also like big companies will often sell bonds. That's regulated by the SEC, and for a long period of time. Right, so you sell a bond in a repayment period of 10 years or 15 years or longer, with semi-annual or annual interest payments to the bondholders. Bonds are a great way for companies, big companies. They can do it. They're safe. Selling bonds only really works when it's safe, because the interest rate is typically lower. So no one wants to buy a bond at 2% interest instead of an equity, unless they know it's going to be safe. So big companies with a long record can sell bonds pretty easily. Okay, so let's talk about more of like how, that's the big overview of the credit market. So let's talk about more about credit risk analysis processes. So this is the whole point of looking at the financial statements and figuring out if there's credit worthiness. So just basic stuff here. So like really all the creditors want to know is what the expected credit loss is. So that's the chance of default times the loss if there is a default. So you figure out, you somehow calculate this, and yes, how you determine credit worthiness. So who does this? Well, anybody that is involved in this. So if you're a creditor, if you're a credit rating agency, if you're a public debt market, if you're in the market to buy a bond, you want to know this. If you're a supplier, you want to do this calculation. If you're going to extend financing terms, you want to know what risk you're having here based on how likely it is they're going to go under. So there's 4 steps with the chance of default to quantify this. It's a very abstract general framework here. So because there's no set in stone way to do this. So just generally, the step 1. If you need to figure out why they're borrowing money. Why is the loan necessary? Like we talked about, there's some risky stuff and there's non-risky stuff. If they're borrowing money because they have so much demand and they need to stock up on inventory, or they need to add on wing onto their factory, that's pretty safe. If it's because they've had year after year of losses and they're running out of cash reserves and they can't make payroll, you need to know that. So the nature and purpose of the loan, right? What it's being used for, if it's a reasonable cyclical type of thing, or if it's against a piece of property. So this is a dumb question. You guys can see the PowerPoint, can't you? Okay, good. I had this fear I'm talking this whole time. You guys can't even see what I'm referring to. Okay, so you need to also understand the macroeconomics environment. Pretty important. So this is why like credit rating agencies and analysts and and investment banks stuff, they focus on an industry because you really need to have a lot of insight into what's going on in that particular industry. So you're going to be looking at what's the industry competition. That affects the risk of the borrower. The bargaining power of the buyers. So if you're lending money to stock up on, say, to help the borrower stock up on inventory, but they're not a well-established, powerful buyer, they're not going to be getting great terms from their suppliers. So that's a factor in it. The bargaining power of the suppliers, and vice versa. The threat of substitution. You don't want to be lending to a company that's going to lose market share because there's some substitute in the market or of the product. And a threat of entry. This is a big one for a lot of companies, especially like retail, a lot of tech, a lot of areas where it's pretty easy to get into it. You would be concerned that while the company's paying you back, some competitor comes in and takes their market share. If Amazon is starting to make noises, they're interested in your industry, you're not going to want to lend to anybody, right? Because they'll come in and demolish. Okay, so then the next step after you understand what the money's for and understand kind of what's going on and what the existential threats to the businesses, the borrower is, then you do some analyze your financial ratios, the actual current numbers and the past numbers. The book makes a big point of this. There is no set ratios to use. Everyone's going to use different ones. But the common ones, you look at the profitability, you look at liquidity, you look at solvency. Those are the ones that make sense, but there's all sorts of nuanced ratios you can do. And then once you have that, you want to project it, do a prospective analysis, because you don't care what the ratios are, if they're favorable yesterday. You want to make sure they're favorable tomorrow when they're paying you back. So you do project what's going to happen over that time period, the cash flows and their solvency ratings. So you forecast financial statements. Okay. So the whole thing is trying to get down to what is the loss given default, the amount of money that can be lost if the company defaults on its obligation. So a default would be if they just stop making payments, or if they violate one of the covenants that it's in your loan that you're giving them, or another loan that would affect their ability to get capital they need to operate. And so this is a issue when it comes to, the thing is, you're trying to avoid bankruptcy. They're trying to make sure they're not going to go bankrupt. So if they go bankrupt, there's a priority of claims. If it's a loan that's collateralized with a mortgage, if it's a mortgage, or if there's some other piece of equipment you can take back, you need to know the priority. Right? If you're the third in line to get a piece of whatever that collateral is, you're not going to get any money out of it. So you need to be aware of that. So bankruptcy code specifies the priority of claims. I don't know. Does anybody know the business bankruptcy code priority? I do, but I went to law school, so I don't know if you guys know. Yeah, so for businesses, so here's the interesting thing about bankruptcy. So if you're a business, why go into bankruptcy? Because you can just close the business. Who cares? Unless you're personally guaranteeing any of the stuff in the business, which happens for small businesses, but not big businesses. So business bankruptcy is about reprioritizing your loans and your obligations, renegotiating them. But the priority list for a business bankruptcy is first the lawyers get their money. So the bankruptcy lawyers get their money first, always. It's good to be a lawyer. And then in administrative costs, so the cost to file bankruptcy, the cost to go through the court system, those expenses get taken. And then any taxes, Uncle Sam always gets his money. And then for a business, employee priority. So if there's payroll due, that comes out next. And then you start going down above and below the line for other priorities. So then it's secured debt gets paid out, then unsecured debt, and then preferred equity, and then common equity. Common equity is the last. So if you're this borrower, if you're lending money, then they go bankrupt, there's a good chance you'll see something because you're in the middle. You're not an equity owner, so you're not going to get the shaft. But where you are in that, and also if you're a third priority on a collateralized loan, you're probably not going to see anything. So the whole point is to try to lend to companies that are not going to go bankrupt. Okay. So some factors. So credit limits, right? So you want to minimize your. So you're doing your due diligence on how likely is it the company will go, the borrower will go out of business. The second part of that is if they do, what's your maximum loss? So you set up credit limits, credit terms to maximize the amount of money you could lose. And these lenders are pretty sophisticated on how they understanding how likely it is based on their experience with others in the industry that they'll lose money on a loan. For trade creditors, they don't allow new buyers to buy very much. They're monitoring their long-term ones because this could have been stable for 30 years. I mean, like Fry's was stable for 20, 30 years and then suddenly went out of business. Sears was stable for 100 years. So they monitor, trade suppliers will monitor even established customers and lower their terms if need be. And bankruptcy law does protect ordinary trade creditors. Anything shipped to a supplier within 20 days can, automatically get your first payout. Also, you can go in and collect those goods pretty easily. With that can, if they're still there, if they haven't been damaged, haven't been stolen or sold, you can get your inventory back. Okay, so collateral seems pretty safe, but like, just like when you have a second mortgage in your house, if you're the second in the priority list, it's unlikely you'll get any money, although that's always the case. A lot of times the first on the priority and the second on the priority will work together. The senior creditor doesn't have to work with the junior creditors, but a lot of them will to be nice because they don't want to screw each other over. They're all on the same side of it. But if you are the secondary, it's possible you won't see anything recovered. And there's time and cost associated with recovering property and then liquidating, getting your money back, selling it, whatever. Not an area you really want to be in, especially for if you have a mortgage on a house, it's pretty easy to foreclose on the house and sell it. But if you have the collateral is some kind of specialized factory or specialized equipment, it can be really hard to sell it, to find another buyer to get your money back. Okay, so just, basic concepts here. The repayment terms are based on the risk. So your interest rate and how long you finance it out. It's the longer you finance it out, the riskier it is, because the company might not go bankrupt in 1 year, but over 15 years, there's 15 times the time that they can go bankrupt. So you want high risk. You want a higher interest rate. Okay, very, very common in business credit is covenants. Almost everything a business does that involves credit will have some form of covenant. And this includes even leasing property, lease an office. And covenants in that be the same, where they'll everything from basic to, you have to, if we want to see your books, you have to show us your books. All the way to you have to take certain actions, or you're restricted from taking certain actions, like borrowing from somebody else. You have to maintain certain financial conditions, like you always have to have so much cash in the bank or whatever. Very, very common. It's very unlikely the lender would not impose some kind of covenant. Okay, so as you're doing your analysis, and as the credit rating agents doing the analysis, they very rarely take the numbers as is. That you have to adjust them. There's lots of reasons why you have to adjust the numbers to make them useful. One of the weirdest ones is that some financial statements are based on a 53-week year, and it's common in retail, and is because if you're not doing a calendar year, you're doing a fiscal year of, like, say, January to January. Every 4 or 5 years, you have an extra day not accounted for, and it adds up to an extra week after so much time. So then suddenly on the 5th year, every 5th year, you have a 53-week financial statement period, income statement period. Well, then that makes the numbers with an extra week in the numbers. If you're comparing year to year, then suddenly that 5th year looks weird. So you have to account for that. So here's like an example of how that works. So Home Depot in this particular case, when they get to that year that does that, they'll list it out on their income statement. Not all will do that. So you got to figure it out and calculate it. How you adjust for that is you take the line items on the income statement that are not the yearly items, yearly items like interest and depreciation. Those are fine, but the ones that are represented in less than yearly, you multiply them times 52 by over 53 to give you an equalized amount. All right, here's just an example they were using from Target of how it can affect by the unadjusted numbers give you a false sense of what's happening. Adjusted numbers really change the scenario. Okay, so then the profitability analysis. So once you've adjusted, if the adjustment needs to happen, you can do some profitability. And why do you care about profitability? If we're talking about credit risk, well, because you need to know if they can pay the loan back. And if they're profitable, that's the biggest indicator. It's like when you borrow your money personally, they care about your income, your salary. If you have no income, they don't understand how you're going to pay it back. So this is where we get back to our ROE analysis from last chapter. Is we can start looking at ROE and the components of ROE to get a sense of the profitability. Okay, so here's another profitability analysis from Home Depot and how they have adjusted it, which as an analyst you'll need to do is you look at ROE, and for Home Depot in 2019, it was negative 5,125%. So what does that mean? Well, that means that for every dollar of equity is out there, they posted a loss of $51. Well, that doesn't make any sense. And what it is, as analysts dig into this, is it turns out Home Depot in 2019 was holding a lot of treasury bills for whatever reason. And holding all that treasury bills was throwing off the equity ratio. So they added it back in. So that analysts add back in that the amount of treasury bonds back into the ROE calculation and adjust it. And then you find out that the actual ROE for 2019 is 20%. Which is very similar to 2018, very similar to 2017. So it's very consistent. In fact, it's going up a little bit. 20% is a very solid ratio. So it really changes the perspective. So if you were adjusting this, then you would think, oh man, they're losing money. Then you adjust it and realize, oh, okay. It's actually a very profitable company. Okay, so just like last week, we started talking about, well, we can look at operating assets, return on operating assets. We can do that for profitability and get a good sense if the company's profitable. So just like we learned last week, we figure out RNOA, and it's our aggregate measure of the operating activities. And this will help us understand if what they're doing is enough profit to just to pay the bills, to pay the interest and the principal payment. So if you remember from last week, in order to get the operating income, you take everything, operating assets, you take everything that's operating, which excludes everything that's interest bearing. So any long-term or short-term debt that you're paying interest on, or that you're getting interest payments from, any assets you're getting interest payments from, you exclude that. But the weird thing is, on our tax code, is that if you're making interest payments on something, you can deduct that as an expense. So it affects your tax rate, or not, it doesn't affect your tax rate, but your tax liability. So to get your net operating asset returns, you have to know your marginal tax rate and add that back in. And then you can get your return on operating assets. So here we have net return on operating assets for Home Depot is at 46%. They're doing pretty good. So they're making a lot of return on their operating assets. Okay, so then we want to also look at coverage, right? The company's ability to generate additional cash to cover principal and interest payment. We call these the flow ratios because they're cash flow and income statement data, right? So there's several different ones. The book kind of focuses on times, interest earned, and EBITDA coverage ratio, and cash from operations, and free operating cash. Yeah, and they're all doing the same thing. It all depends if you're a GAAP person, not a GAAP person. You would use different ones, but they're not going to vary too much. So the times interest earned is the earnings before interest and tax over interest expense gross, and then you come up with this ratio. So Home Depot is at 14.5 in 2019. So what does that mean? That means that it can cover its interest expense over 14 times with its earnings. So that's pretty good shape. Right, we're not worried as a lender that they're not going to be able to cover their interest payments. Right. Why we only care about interest payments? Because the assumption is that Home Depot is just going to keep refinancing the principal and never really pay it off. And as long as we keep getting our interest payments, we don't really care. So that's really what we're concerned about. Okay. So there's also, you can add in depreciation and amortization as amortization. That's a hard word to say for me tonight. Why would we do that? I mean, neither one of these are GAAP approved. So, you can use either one you want. Adding back in DNA, these are not cash flow expenses or factors. So it doesn't materially alter the ratio. But it's kind of more accurate, right? It's more data in the equation. It'll always be higher than the last one, the earnings before interest and tax. But it kind of gives you a little bit better idea of the actual coverage ratio. So in this case, it's 16.5. So Home Depot is doing even better than we even thought. They're really, really not at risk of not being able to pay their interest. You can see here, the book says that the EBITDA will always be a higher coverage number than times interest, and Home Depot is very, very strong for the 4 years this is over. So we can also do based on cash flow. So we can look at cash from operations to total debt. Right, so pretty standard ratio there, cash on top, and from operations, from operations, not from investment activities, over short-term and long-term debt. And you can also do free operating cash. So here you're going to want to do your cash from operations minus capital expenditures. This one's really nice because capital expenditures are just a thing of business. You're going to have to make in capital expenditures every year, every couple of years to replace equipment that's wearing out. And when you subtract CapEx from your cash operations, then what's left is called free cash. It's just assumed that that's extra cash. That's the dessert you have after you eat your vegetables. CapEx is your vegetables. So when you factor that in, that's a ratio that shows really how strong you are to pay your debt. So here is Home Depot's. So their pre-operating cash is pretty high at 35 all these 4 years. Who would have thought Home Depot was such a strong company? I mean, retail companies are kind of weird because they have so much debt from their supplier financing their suppliers, right? But Home Depot is not caught into the internet craze. You don't buy home improvement and wood and stuff, whatever, from Amazon. So they're really strong. I'm surprised at how strong they are. Okay, and then liquidity, the quick ratio and the current ratio. These are what I'm trying to think of. These are the gold standard of ratios. You learn these in every finance class if you haven't learned them already. The current ratio is your current assets over your current liabilities. So not long-term stuff. This is within the next year. How strong is the good stuff versus compared to your liabilities. And then the quick ratio is even more narrowed. And so it's not just all current liabilities, it's your cash plus marketable securities plus accounts receivable. So this is the quick stuff. This is the stuff that can be liquid really quick over your current liabilities. And of course, the higher, the better here. So we can look at Home Depot and see that with their current ratio, 1.2, 1.4, excellent numbers, excellent ratio. So they have quite a bit more current assets than liabilities. But when you look at how they're the most liquid, cash and whatnot, not quite as good, but not bad. I've seen a lot worse. Okay, and then like the last chunk of ratios here is the solvency. And this is how likely the company is going to be able to meet its debt obligations. The solvency is pretty crucial. There's two common solvency ratios. That's total liabilities over shareholder equity, and then also total debt over shareholders. So you look at your total liabilities, right, or your total debt. What's the difference there? Okay, so the second one, distinguishing operating creditors and debt obligations. Okay, whatever. So these are going to be showing how likely it is that they'll be insolvent over the next year period. So this is very industry specific. So another area where you really have to know your industry to understand this. Some industries that, like oil and gas and computer hardware, have a lot liabilities to their equity, but others like home improvement and motels have a lot of cash flow. So it changes that equation. So if you have a lot of cash flow, you're more likely to want to lend to them because they're going to have the cash coming in to pay it back. Okay. So where are we? Credit agencies. Credit agencies, rough time for them. They really got called out in the Great Recession. They're businesses. So their product is this credit rating, and their customers aren't the investors, they're the companies. So there's a lot of controversy back in the Great Recession when it really came out that the ratings were way off. And it turns out they're pretty motivated to give artificially inflated ratings to keep their customers, which are the corporations they're rating. But that aside, in general, how they work is they are experts in the industry and the competition and in the financial analysis, and they're privy to non-public information. So the company public companies can give the rating agencies non-public information, and the rating agencies can use that then to give a public rating. The ratings are, I don't know why they're in rating like this, but the highest is AAA, going down to the B AA, 3 or B triple B minus, depending on the rating agency. And those are investment grade. And then below that is non-investment grade. So these are very speculative. These are high risk. These are not for your average investor to buy into. Why is that? Well, here's the data. The likeliness of default for the investment grade is very low, in fact, 0% for almost all the investment grade. Then once you get a non-investment grade, the likeliness for default goes way up. So these are for people that like a lot of risk. Okay, and the general process for a rating is this process. So, but remember, the customer is the company being rated. So they make an application to Moody's or whatever, and then they provide privileged non-public data, and they do this for a reason. They do this because it benefits the big companies and the government, whoever's getting rated. It benefits them because it affects how much money they can borrow, and it affects how much stockholders want to buy into the company. And then the last step in the process is surveillance. So in theory, the credit rating agencies are monitoring. They do a AAA or whatever it is, and then they monitor that and downgrade. And it can be devastating when they issue a downgrade. It can make stock crash overnight. Okay, so this is an interesting thing. That B plus, BB, that's the first stage of the non-investment grade. And it's so low there as evidence that companies try really hard to stay in the investment grade. They really want to stay out of that. So everything below BB minus, they don't care. They can't get up to investment grade, whatever. But if you're on that cusp, they really work hard to stay on the investment grade side of the ratings. And why is all that? Well, like how's it correlate to all what we're learning here? So what you can see here is all these ratios. So if you're looking at a AAA and you're looking at your earnings before interest and tax over your interest expense, you see that there's certain thresholds. Lower is worse on this ratio, and you can see that it goes lower as the rating goes down. And debt over EBITDA, it goes up. So that's how these ratios come into play. You start chunking in the ratios, strong ones with other strong ones, and that's what is justifying the rating. Okay, lots of stuff with the credit rating agencies. There was this Reform Act that was passed some time ago that established a registration system, but only very few are registered, good and bad. The good arguments is that by registering with the SEC and the SEC allowing it, it's allowed for more competition, because some of the smaller ones, if they can get registered, now could compete against the big ones like Moody's. On the other hand, it's like a constraint on the industry that the government has to approve, or doesn't have to approve, but they can approve. I don't know. I don't have an opinion on this so much, other than to say that the credit rating agencies have lots of controversy around them. Okay, and then I think lastly, what we have here is the Z-score. Z-score is pretty cool. It's this, I'm guessing this was some kind of like statistical analysis, some kind of regression analysis that came up with this. But essentially, you take these ratios and times them times the 1.2 whatever, and add them together, and you come up with a Z-score. And then it turns out the Z-score becomes an extremely solid predictor of solvency within the first year. So if your Z-score is above 3, you're very unlikely to go insolvent within the first year. As that Z-score goes down, the more likely a bankruptcy is. Very accurate within a year, and the accuracy kind of diminishes quickly as farther on in time. It's like predicting the weather. It's pretty easy to predict the weather this week. Pretty hard to predict the weather 10 years from now. Same kind of thing. There's just too many variables. Okay, so then as you can see, they applied it to Home Depot and it's got a Z-score of 7.7. It's pretty simple to do. It's literally running these ratios times the weight and adding it up. So Home Depot is very healthy. Okay, any questions on all that stuff? I know it's a lot. Yeah, okay. Well, here's what we're going to do now. I'm going to assign some problems. Okay, hold on. 1, 2, 3, 4, 5, 6, 2, 3, 4, 5, 6, 7. What am I missing? Oh, I see all this. Okay. I'm going to assign some problems, then we'll take a long break. I want you guys to work on the problems, and then we'll come back and go through and you'll show us how you came up with answers. Does that sound good? And these are the problems that are going to be on the tests. So that's why we want to work through them. Nithin, I'm sorry if I can't remember how to say everyone's name. Nithin, is that how you say it?
Yeah, it's correct, Professor.
Okay. So write this down. So we're talking about in the back of chapter 4, we're talking about the mini exercises and the exercises. So what I want you to do is I want you to do Q4-1 and Q4-2, and then M4-15, and E4-22.
Okay.
Okay.
I'll repeat the questions. Q4-1,
Mhm.
Q4-2, M4-15, and E4-22.
Yeah. Okay, Nicholas, Q4-3, Q4-4, M4-16, E4-23. Okay. Mario, is it Mario's? Marius? Hey,
Yeah,
Sid.
Mario's.
Okay, Mario's. Okay.
Professor, I have an issue. I don't have the book yet. It's on back order from the store.
Okay.
I tried to get it from the store here, but it's on back order.
And so you're not, you have access to the online Moodle?
No, not yet.
Okay. Okay. So I guess you don't get any problems this week, but pay attention to the other problems. And when you get your book, make sure you work through these exercises.
Okay.
So you're prepared for the test. Okay. So then we'll go Teddy. Q4-7, Q4-8, M4-18, E4-25. Okay. Chris, Q4-9, Q4-10, M4-19, and E4-26. Did you get that, Chris?
Yep, got him.
Okay. Ko?
Yep, I'm here.
Okay. And I got that right, Ko? I'm sorry, I can never remember.
It's Cow.
Cow, that's okay.
Yeah.
I'm sorry.
No, you.
Okay. Q4-11,
Q4-7,
Q4-12,
Q4-12,
M4-20,
M4-20,
E4-27.
E4-27. All right.
And then Taylor. Q4-13, Q4-14, M4-21, and E4-28. Okay, so start working on those. I think a half hour will be enough. If you can't get to all of them, don't worry about it. After a half hour, we'll come back and we'll start with Nathan and go through and walk us through how you solve them. Okay. Okay, so I'm going to pause the recording and then turn off my video, and we'll come back at 8:40. All right, so it's been a half an hour. Hopefully we had enough time to work through those. All right, so I don't want to put anybody on the spot. So if you struggled with one or didn't get to one, no need to, we can skip it. Otherwise, what I'd like to do is start with Nathan and read us the question and then work us through how you solved it. All right, so let's start there. Nathan, you ready?
Yeah, Professor. I actually missed out just one part of the last question. I couldn't solve, but I'm prepared with the rest of the questions.
Are
Am I
you,
audible, Professor?
yeah, are you still in India?
Yeah, I'm still in India.
Oh, okay. What time is it there?
Right now it's 10 a.m. 11.
In the
Yeah.
morning?
Yeah, in the morning.
Yeah. All right. Okay. I'm sorry. So I didn't catch what you were saying. So did you say you're ready to go, or what? What did you say a second ago?
Yeah. The last questions, last part I was just left out. I was just solving that, but I'm prepared with the rest of the questions.
Give us what you got and skip anything you're not
Yeah.
ready for.
Okay, that's good. So the first question was a theoretical question. That is, companies often borrow money to fund operating activities. Why do lenders distinguish between cyclical cash needs and cash needed to fund operating losses? So basically, they're actually asking for the difference between the cyclic cash and an operating cash cycle. So um, I mean, like I have written in the notes. Can I just read it? What I have written over here?
Yeah. So I think what they're getting at, I mean, so what they're getting at is what's the risk profile difference? Is one
Yeah.
riskier than the other?
Yeah. So basically, I mean, as we all know, like operating cycle measures the time taken a business to convert its inventory to the cash.
Mhm.
And while the cash cycle takes into account that a business does not have to pay its creditors right away.
Yeah.
So that's the major difference between your operating and a cash cycle.
Yeah. Okay. And then what about next question?
Yeah, the next question was explain how a company's need of cash for investing activities differs over the company's life cycle. So first thing, companies investing activities differ every year. You know, like for purchasing your either a property or a property, plant and equipment, or for corporate acquisitions and all. And even the needs for cash investing vary on the basis of timing and even the amount. So every year you can't expect that the investing activities would be the same. So you can't predict that so and so year I will be investing so much of amount. So that's a major thing about the cash investing activity. And they've asked suggest 3 reasons a company would borrow for financing activities. So for financing activities, majorly the company borrow because to repay its either the bonds or the debentures or for buying back of the shares. And I mean it's the repurchase of the shares.
Yeah.
Yeah. So those are the 3 things. I mean those are the basic 3 things for why the company borrows for the financial.
Yeah. And those are right on, both the investment and the financing activities. Good answer.
Financing activities. Yeah.
Okay. So what about M415? Did you get to that one?
Yeah. M415. I got it.
Okay.
I'm opening the question. Yeah. So firstly, they have asked for the determine the expected cash credit loss for each company. So there were 3 companies, and they have given us the chance of default and loss given default. So going by the formula of expected credit loss, it is chance of default multiplied by the loss given a default. Sorry, loss given default. So for the company A, it is 10% of 3,000, which is $300. And for the company B, it is 25% of 2,000, which is $500. And for company C, it is 40% of 1,000, which is $400.
Yeah.
And
Perfect.
the second part of the question was which company has the high credit risk? So like as per my understanding, credit risk can be calculated using the various ratios and all. Due to lack of so much of information, we can say that chance of default is more in company C. So I felt company C has a high credit risk.
So C is high, but is that higher? Is it higher than is it higher than B? So B is going to have an expected credit loss of 500.
Okay. 500. Okay. Okay. I got it. So it's actually company B which is having the high credit risk.
Yeah.
Okay.
Yeah,
Okay.
I would think B. I mean, they're both high. That's
Yeah,
the
both
problem
are
with doing
high.
mathematically B is the highest risk, but that 40% fault chance is so high, but then they're
Yeah.
only potential losing 1,000, so that's why it lowers that. But yeah, perfect. Great answer. I hope everyone got how he got there. And it's on page 4.8 of the book. Chance of default times loss given default gives you that number. Okay, and did you said you didn't get to the last one? You're still
No. In the last question, the first part I was able to complete. The second portion I couldn't complete.
okay. Well, go ahead and tell us the first portion then. E20 or E422.
Yeah, E422. So basically, they're asking for all the 10 the 10 required formulas. So the first one was debt upon the EBITDA, which was clearly from the question itself. EBITDA, we can see it was 9859. Sorry, the debt upon the EBITDA. Debt was $9859 and EBITDA was $2537, which is operating profit.
Okay.
It is 3.88.
Okay.
The next one was EBITDA to the interest expense. So over here, I had to remove the depreciation amount. So it comes up to 2537 minus $306. That comes up to 2231, which is the EBITDA upon the interest expense. Interest expense, we had to take a gross amount. So since they haven't mentioned anything about the tax, I'll take the total interest expense gross, which is $181.
Okay.
So the answer comes up to 12.32.
Yeah, sounds right.
Yeah, and then the next question was a straightforward question, which is revenue, which is given in the question itself.
Yeah.
That is $13,601. And then retained cash flow to the net debt. So retained cash flow, what I understood was your operating cash flow. So that comes up to 2610, which is given in the question. And the debt is 9859, again the same. So that comes up to 26.49%.
Yeah.
And
I think your logic follows. I don't think though that retained cash flow, they're referring to operating profit. Does that in the book that retained cash flow is operating profit?
no, that's what I did not search in the book, but I just casually Google searched it. It says your operating profit. I mean operating cash flow.
Yeah, so it looks like if you look on page 431 in the exhibit 4A, retained cash flow is funds from operations minus preferred dividends minus common debt. Yeah, it's fine. Your logic flowed. It's just we didn't have the exact right formula. But
yeah, exactly. Yeah.
Okay, so go on to the EBITDA
next,
margin.
next it was EBITDA margin. The formula goes like this, like EBITDA upon your revenue. So EBITDA previously we had actually calculated, so it comes up to $2231 upon your revenue, which is $13,601. So that comes up to 16.40%.
Okay, yeah, sounds right.
Then your operating profit margin. So just we had to replace EBITDA over here. So operating profit upon revenue, which is 2537 upon 13,601.
Okay.
So that comes up to $18.65. Sorry, 18.65%.
All right.
And the next question was funds from operations upon the debt. So, funds from operation they have directly given in the question, which is 2852 upon your debt, which is 9859, which comes up to 28.92%.
Yep.
The next one was your interest coverage, which is funds from operation plus interest upon the interest expense. So the free fund from operation was 2852 and the interest expense was $181. So that answer actually comes up to 16.75.
Yep, that's what I have.
And the last but one, that was EBITDA to the average assets. It was actually the straightforward. That was 2231 upon 24713. That comes up to 9.02%.
Great. Did you get the CapEx one?
Yeah, capex upon the depreciation was 572 upon 306, which is 1.86.
Yeah, yeah. So you I think you got the handle of that. So you know, with all financial analysis, the actual
Yeah.
math is always really easy. Simple ratios, and the trick to all this is knowing what it all means.
Yeah, as far as you get the amounts exactly correct, so it's just a matter of dividing.
Yeah. Okay. Well, great.
Yeah, that next B part I couldn't do.
It's
I ran
fine.
out of
I think you're right on. Yeah, use your comment. So the next part would be to do the analysis. It's fine for today. You might want to look at that and think it through if you have time this weekend or whatever, because that might be on the test to do the analysis
sure.
part. But
Yeah, sure. So exactly what I had to do in the B part, Professor, to estimate the long-term debt rating.
yeah,
is it, calculating Z-score?
Yeah, if you look on 431 exhibit 4A 4.8, you take all those equations, all the ratios you did, and find where they fit in, and then pick the rating.
Okay.
Yeah.
Good. I got it.
Okay, well, great. Perfect. You worked through all those perfectly. I appreciate you going first. All right, Nicholas,
Thank you.
let's go over to you. So question Q4-3.
All right, perfect. So that is identify 3 parties that routinely supply credit to companies. I got trade creditors, banks, and leasing firms.
Okay.
Perfect.
Yeah.
And then Q4-4, it's distinguished between a line of credit and a letter of credit, and why do companies obtain lines of credit? So the line of credit just increases liquidity and then provides a guarantee that funds will be available when needed. Kind of the need for that is that if a company does need funds, they have it available. And then a letter of credit is a form that will guarantee the lender that their money will be paid.
Yeah, exactly right. Okay, so how about M4-16?
Perfect. So that is Comcast is rated A3 by Moody. And then what factors do you believe contribute to Comcast credit rating? This one I was a little confused in because I was looking at the one in the book, and I don't know if they used Moody's credit rating for 4.8 in the book, but the only one I could really come up with was revenue. That's the only factor in there that was leading me to believe why they had a AAA rated.
Yeah, it's interesting. So I'm looking through it now. So debt over EBITDA is
Theirs was pretty high.
Yeah, it's down, it's down there. EBITDA to interest expense 5.6. Yeah, why? These are all, this should be way down, like in triple B, AA, and BA.
That's what I was thinking.
Yeah. So, if you watch the video, and I guess actually they probably book kind of goes into it too. But if you watch the video on the publisher's website on this section, they do go into a little bit of how the rating agencies are free to move things around, and part of that's because they have access to non-public information. So it very well could be that even though the public information numbers don't seem that strong, they know something that's non-public that allows them to be more secure. For Comcast, you would look at that it's a very, very high revenue, very high cash flow, cash cycle, right? They have $1 billion every month coming in cash. That might be affecting it, definitely, but it is weird that every indicator is so lower than the actual rating. Okay, what about the E423? Did you get to that one?
Yeah, or at least most of it. So part A is compute profitability measures, RNOA, ROA, and ROE for 2019 and 2018. So for 2018, for RNOA, I got a 0.28. For ROA, I got 0.11617. For ROE, I got 0.8. And then for 2019, RNOA got 0.29, ROA 0.17, ROE 0.18, 0.12, or 0.82. And
Okay.
then, for B, it's adjust equity and total assets for the amount of treasury stock, and then recompute all three for both years. So for 2018 and 2019 for RNOA, I kept those the same. For 2018 for ROA, I got 0.07, and for ROE, I got 0.2. For 2019 for ROA, I got 0.17, and for ROA, I got 0.09.
Okay. Yeah, I don't have that one worked out. I'm going to trust that you got the numbers right. They do sound right. So for RNOA, can you explain why you didn't adjust it for the treasury stock?
I just remember you saying that the treasury stock, or actually because it's RNOA is calculating operating assets. Well, stock is not an operating asset, was my knowledge behind it.
Okay. I'm not going to argue with that. I don't know if I know the answer off the top of my head. It could very well be. I would have to look it up. So the only thing I can think, yeah, that's probably right. Like I said, I don't have the answer in front of me on this one. So I'm going to cautiously say I think you did that right.
All right, I like it. And then part C is what profitability measures better reflect the company's profit levels during the 2 years? I didn't really understand that part of the question, whether it was which one looks the best for the company or which one does the best job of measuring.
Yeah.
So,
Yeah. Well, what do you think? As you look at your numbers, what seems to be the most realistic?
I'd probably go with ROA, just in the fact that it does account for the stock, and then with adding in the stock, it doesn't have these huge changes. ROE essentially flip-flops, and then for RNOA, it's just for their operating assets.
Okay, I'll go with that. I think your reasoning's sound. Okay, great, thank you.
Yeah.
Teddy.
Yeah. So first I had Q4-7, which was what are the 4 steps to assess the chance of default for a company?
Mhm.
And those are the 4 steps that we talked about earlier today when we were going over the slides. First being evaluate the nature and purpose of the loan. It's pretty self-explanatory. And then number 2 would be assess macroeconomic environment and industry conditions. And I think the book and you went into the Porter's 5 forces as assessing the industry conditions, which are the threat of substitutes, accessibility or like learning curve of new entrants, the competition intensity, and then supplier power and buyer power. So yeah, just assessing kind of the industry environment to see if it's a good investment. 3 would be to analyze financial ratios, like what we've been doing with the RNOA, ROE, quick ratio, current ratio, just assessing the numbers that the business has. And then number 4 is perform prospective analysis. So just kind of getting an idea of how this might be of value to the creditor. So
Yeah, and a little bit of forecasting what the future's going to be.
yeah.
Okay, and then Q48.
Yes. That question was why are missing or understated liabilities especially critical for credit analysis? And I couldn't really find it much in the book, but I just kind of thought to myself about it, and I was thinking because if they're really bad or if they're really huge liabilities that are not abundantly clear, they can really negatively affect a company's solvency and kind of affect their ability to pay off debt if a creditor were to give them money.
Yeah.
So.
Yeah, you're exactly right. I mean, it's not a trick question. If there's some liability not factored in, that means that they'll have less money to pay back the loan.
Yeah. All right, next was M4-18, which was the question about Best Buy, which was comparing fiscal years in 2019 and 2012. And it's asking what can you learn from an internet search that explains the change over time? And in 2012, the Best Buy seems to be their RNOA, ROE, and time interest earned are all negative. And their cash from operations to total debt is 0.855. So below, their debt outweighs their cash from operations.
Mm-hmm.
And so that in 2012, it's very clear that they're in a bad spot.
Yeah.
They don't have profits and they don't have they don't have enough operating cash to kind of cover all of their debt. But then when we look at the numbers from 2019, their RNOA is 65, almost 65%, and then ROE is 42. Time interest earned is their time interest earned ratio is 26, and then their cash from operations total debt is 1.7. So they've obviously improved quite a lot and regained profitability and ability to pay back on their debt. And then from the internet search question thing, I think I did one really quick, and it was pretty clear that in 2012, Best Buy was just suffering really poorly from the kind of retail crunch that happened from online e-commerce and stuff, like when Toys R Us closed, and like Sears, I think, was around then, I think. But yeah, so it seems like they just were able to regain profitability by means of probably embracing e-commerce and other strategies. I don't know, but yeah.
That makes sense to me.
Yeah,
I think you analyzed that quite well. Okay, and then what was the last?
The last one was E4-25, which was Ford Motor Company analyzing. There were two different parts of their company, their automotive and financial services sectors, and then the Ford Motor consolidated branch. For all three of those, I was supposed to compute ROE times interest earned ratio and total liabilities to equity. And I did all that. It's probably going to be easier if I share my screen. I did it on Excel.
Yeah, let's do that.
Oh, I am unable to do so.
Well, I probably need to do something here. Let's see. Okay, try it now.
Yes, cool. All right, can you guys see my Excel screen?
Yeah.
Okay. So I just put in the table that was given to me, and then using these numbers, I computed the ROE of each of these different firms, as well as the whole Ford firm. I did ROE times interest earned ratio and then total liability to equity using these formulas. I think these are right. Some of them I Googled, So maybe they're different from the book. But ROE was net income divided by equity. And then time interest earned was EBIT divided by interest expense. So that's these three divided by interest expense again. And then total liability to equity is liability divided by equity. And then I just did it for all three of these. And then the colors indicate, I also Googled like, what is a good ROE?
Mhm.
What is a good total liability? And then obviously you can, I'm sure everyone can figure out that green means good and then red
Yeah.
means bad. So
Yeah, so if we look at, say, the ROE for auto 0.22, what is that telling me?
that is return on equity.
So it's 0.22, you have it green. Why is that good?
That is a good question. The net the net income, I don't know.
Yeah, so you're getting a 20% return on your equity dollars.
Yeah.
So your one equity dollar is returning $1.20. That's pretty good. Now the times interest earned ratio, the 9.26, that's green. Tell me again what that's telling us.
Times interest earned was I've written down. It's how many times over they can pay for their interest payments. So 9 times over is obviously very good.
Yeah.
And then I think the threshold was like 2.2 on Google for like a good number or whatever. But the ability to pay their times over of interest. So that's good.
And then why are these red ones bad? Total liability to equity. What's that 9.8 telling us?
That their liabilities just massively outweigh the equity that they have. So 9.8 just means that they have a lot of debt.
Yeah. And that's not really the point of this ratio, but one outcome of this is that liability gets paid first in bankruptcy and then equity. So there's no way if there's bankruptcy, any equity owner is getting anything out of that.
Yeah.
Okay, great. Yeah, I love the spreadsheet. And I love the color coding. Okay, Chris.
Yeah, I had Q49 to start with.
Yeah.
So it explained concepts of liquidity and solvency. So liquidity, cash availability, how much cash a company can generate on a short notice.
Mhm.
Solvency, company's ability to meet its debt obligations.
Yeah.
Why is performance on these two dimensions crucial? Liquidity helps a company with financial challenges when you need to pull money out. Solvency, it's kind of measures financial health, demonstrating a company's ability to manage its operations. And then coverage analysis differ from measures of liquidity and solvency. I wasn't sure. I just put the ratios like current ratio, quick ratio, then liabilities to equity, and then total debt to equity.
Yeah, I mean, it's the same kind of thought process you're already at. Just expanding it out to those coverage ratios. So you're right on track. It's the same thing. It's how they're all showing how likely it is that you can survive a crunch. So with the coverage analysis, you're looking at current assets, and so it's the same analysis there. Okay, the next question, 410.
U410, so it's what two factors determine a company's level of credit risk: chance of default and loss given default. And those equal, multiplied together, those are expected credit loss.
Yeah, so, exactly right. Okay, and M419.
M419 was the fiscal year, 53-week fiscal year chart of Kohl's pulled from its 10K. So the question was, what concern do the different fiscal period durations present for analysts or analysis? And I wasn't sure, but they ended on different dates. So one ended 2nd of February the 3rd, then January 28th, and then the number of weeks were different. So one was measured with 53 weeks and they earned 52 weeks. So I don't know if that would make a huge difference.
1 extra week. So if you're doing $1 million a week of revenue, 1 extra week throws your numbers off by $1 million. All right. So that's the problem. That's what you have to equalize it out to that 52.
Sounds good. So yeah, that'd be hard to compare. So Cole's income statement includes the following amounts for sales revenues. How might we compare year to year? And so it just gives the 2018 all the way back to 2016. It looks like income or sales revenue went up from 2016 from 19,000 to 20,000. Did you need to do anything for that part B?
Yeah. Let's see here.
Like a ratio or something, or?
Yeah, I think what it might be asking to do is do that 52 over 53 times for 2017. Yeah, I think that's what it wanted to do. Take the 20,084 times 52 over 53, and then you can compare it to 2018 and 2016.
Okay.
It's not clear from that question, but I'm pretty sure that's what it's asking you to do.
Okay. Sounds good. And then I got to E426 and finished, but it just wanted to do all the ratios, liquidity, solvency, coverage. So I started with current assets, and I got a current ratio of, or current assets over current liabilities. I got a current ratio of 2.19. So is that 2-to-1 ratio?
Yeah. So that's pretty strong. Because
then,
current is assets over liability, so twice the assets, a little more than twice the assets.
okay, the liabilities. Good. And then for the quick ratio, it has the chart sheet up, but I was still trying to determine what all would go down as marketable. Cash is there, accounts receivable is there. So I was trying to see what else would go in that top line over liabilities.
Yeah, what is it? It's cash, accounts receivable, and like one other one. I can never remember. But you're on the right track. So you did your best guess and then did over total or current liabilities.
Yeah, I wasn't sure which one I was missing, so the number was going to be off, so I didn't finish. But it's quick ratios, current assets minus inventories minus prepaid expenses over current liabilities. Or is it cash plus cash equivalents plus marketable securities plus accounts receivable over current liabilities?
Yeah, we gotta look it up. The main thing to remember with that ratio, with the quick ratio, it's the most liquid assets. So that's the difference. So it's cash plus marketable securities plus accounts receivable.
Okay.
So it's what can be liquidated instantly, because of course cash is always liquid. So that's what it's telling it. So it's even more immediate than the current ratio.
So like for the test, which one of these on here would we make sure to include? Like cash, obviously. What about short-term investments?
Yeah, I wouldn't do short-term investments because short-term investments is 90 days, but it's not as liquid as cash and marketable securities. So marketable securities is like if you have a stock in something, right? So you can sell it on the open market instantly. Yeah, so I would look for the things that are just almost instant and being turned liquid.
All right, and then yeah, I didn't make it to solvency ratios or coverage ratios yet.
But you get the idea. So again, you just look up the right ratio and then look at what it's trying to tell you to get an idea of what what it's doing, if it's good or bad. Great, thanks, Chris. And then Cal.
Yeah, so the first question I got was, let's see, question 4-11, and that asks, why do lenders require collateral? And then just give some common types of collateral.
Yeah.
So basically, lenders require collateral because they want to minimize the loss in case of default. So they basically want to get some of their money back just in case the borrower defaults.
Mhm.
Some examples are like PPE, such as real estate, equipment, and house or car for like a personal loan.
Yeah.
Yeah.
So
So
I like, as you can tell, when I do my lecture, I'll try to compare it to like consumer stuff like car loan, because I think that really helps us connect the business if you're not familiar with the business world. So if there's ever a short answer on like a test, I haven't made the test yet, but feel free to throw in a comparable to something that's in our daily lives if that helps the analogy. That's a great way to make sure you're clear. Anyway, go ahead.
yeah, so the second question I got was Q4-12,
Mhm.
and that asks, why do lenders impose a debt covenant on borrowers? So they just want to restrict the borrower from taking certain action that would jeopardize the borrower being able to pay them back. Some examples are like changing management team, increasing dividends, making major investments, doing mergers or acquisitions, and especially taking on additional loans or debt. And then some covenant requires borrower to maintain a specific financial ratios.
Yeah, great examples.
For the exercise, I did M4-20.
Mhm. The Z-score.
Yes. M4-20. Okay, so basically it just shows balance sheet for Logitech. Is it okay if I share my screen? Maybe that would make
please
it
do.
easier for people to see. Can you guys see my screen?
Yeah.
Yeah, so for M4-20, so I put in the rates because
Mhm.
that's what the equation that's you had to use the weights and the ratio and multiply those to get the score. And then so here's the financial ratios. This is a working capital divided by total asset, and then I times the financial ratio by the rate to get the score, and then in the end I just added them up. So the Z-score I got for Logitech was 3.16,
Yeah.
and that's above the 3.0 threshold, so they are healthy. So they are not at risk of being default within a year.
Yeah, and within the year. Perfect. I was about to ask that over what time frame, but within the year is the key time frame there.
And then so the second question I got was E4-27,
Mhm.
and that's just basically the same thing about comparing Procter and Gamble and Kimberly-Clark. So again, I did the ratios based off of the balance sheet, and then I multiplied the ratios by the weight to get the score, and then I just basically add up the score again. And then comparing the scores, I can see that Procter and Gamble had a Z-score of 4.26, and Kimberly-Clark had a score of 4.17, and they're both over the 3.0 threshold, so they're not going to be default within a year. So based on the score, I would say that Procter and Gamble has a high score, so they're more healthier than Kimberly-Clark.
All right, sounds good. Perfect. Thank you.
Yeah, you're welcome.
Okay, Taylor.
Oh, hold on, how do I get out of this?
Yeah, so the first one, really all of mine were about Z-scores. But my first question was, what is a credit rating? Why do companies care about their credit ratings? Pretty textbook answer. Credit rating is a quantified assessment of borrower's creditworthiness, or their ability to repay a debt obligation. And why do companies care about the credit ratings? Because it affects their ability to get credit, loans, issue bonds. It also affects the terms of those debt instruments. So obviously, higher credit rating company has, the better terms they can get.
Absolutely right.
My next question was Q4-14. Explain in general terms the Altman bankruptcy prediction model and what do each of the 5 variables measure. As Cal was talking about a little bit, the Altman bankruptcy model is really just a formula here with all these ratios times a bunch of terms. I'm not going to read the whole formula out. It's in the book.
That's fine.
But it's got 5 terms, basically working capital over total assets, which is a measure of liquidity. The second term is retained earnings over total assets. The third term is EBIT over total assets. Those are both kind of measures of profitability, both long-term and short-term. The fourth term is market value of equity over total liabilities, which measures leverage. And the last term, sales to total assets, just measures kind of asset efficiency. So that's basically the
great answer.
Describing the formula.
Perfect answer. My favorite one is sales over total assets times 0.99. Like, how do they come up with 0.99 versus just 1?
Yeah, I'm not sure where they came up with the ratios. It seems kind of arbitrary. The multipliers in the formula, but yeah, I don't think the book talks about it. I didn't read too much into it. All right, my third question was the M421 bankruptcy risk and Z-score analysis. I didn't Excel, but I already closed Excel. But basically, it was gave you the balance sheet for Tesla for 2 years, 2018 and 2017, and basically gave you all the terms and said calculate the Z-scores. The Z-score I got for Tesla for 2017 was 1.26, and for 18 it was 2.24. So it's basically like evaluate the Z-score and is the company at risk of bankruptcy. So the little Z-score chart, 2017 is 1.26, which is on the lower bound of the chart. Under everything under 1.8 is basically everything's in financial distress and high risk of bankruptcy.
You know anything about Tesla in 2017?
No, I don't know too much of their story. Financially, at least, I'm well aware of Tesla, but
yeah, they were actually the claim is within days before the Model 3 was finalized and came out, they were expecting to go into bankruptcy any day. So that number is very consistent with what the official story is, that they were in very bad shape in 2017.
Yeah, that's crazy. That would have been a shame. Yeah, so then 2018 is 2.23, which is kind of in the middle bound. So they're still at some risk, but it says caution advised. So obviously they improved from 2017 to 2018.
Okay.
So that was
28.
Yeah, and then 28 was basically the same thing, but for Netflix. And for 2017, I got 5.45, and 2018 I got 6.0 basically.
Yeah.
So way above 3. It was compute the Z-scores. What explains the apparent trend? I'm not sure what the apparent trend is, but basically they've improved from 2017 to 18 from good to great. I said the current uptick was in an increase of retained earnings mainly was one of the major deltas from between the years. It says the company more likely to go bankrupt given the Z-score in 2018 compared to 2017. I said not really. I don't think there's a big difference between basically 6 and 5.5. They're well above 3, so I don't think they're.
Netflix is a heavy cash business, so they tend to have really high Z-scores. So Netflix is getting, like it says here, almost 10 billion a year in cash on a regular basis, with few fixed assets and few fixed liabilities. So it's very, very low credit risk.
Yeah, so almost no bankruptcy risk in either year. Right.
And especially since they acquire their liabilities are about acquiring rights, and those are often structured as payment based on the revenue. So it's not like they need to have a bunch of warehouses and inventory. And even their asset, they don't own their own server farms, so they pay lease, so they can expand and contract their liabilities as far as their server usage as they need, so they don't ever have too much that's not being used. Okay, well, I think that worked really well. I think we'll do the same thing next week, lecture, and then assign the problems from the book. And then in 2 weeks, we'll have our first test. I'll pull questions very similar to these problems that we're going over. So we should have some experience doing that. Okay, any final questions before we call it a night? All right, I'll see you guys next Thursday.
Thank you.
Thank you.
Thank you.
Thank you. Bye, Professor.